a component of company's management. The topic we are taking tonight is closely related to the topic that my colleague Adijuwon took you guys. We are looking at capital structure and theories of gearing. No, please, can you mute? Please, let's check our mic, and mute. Emeka, please, can you mute? Precious, please mute. Mr. Peter, please, can you mute? One of the rules of engagement with this class is, as soon as you get to the class, you look at your audio, that is your speaker, and mute. I have Taiwo, not muted. I have home care, not muted. Please, can we mute? All right, let's go to the business. The topic is capital structure and theories of gearing. Like I said, this topic is closely related to cost of capital computation. As we all know, this is the first time we are having financial management at skills level. And I believe the intent, the objective of this new syllabus, we assist students when you get to the final stage of your examination. Precisely what is financial management? Let us do a brief overview. When you say financial management can be defined as the management of companies' finances. Financial management can be defined as the management of company finances with a view to achieving the company's objective. It involves identifying the various sources of finance and how to utilize finance to achieve the objective of a business entity. In other words, if you are talking of financial management, the ability to raise finance and to utilize the finance to achieve company's objective. If you look at that definition, it implies that as a finance manager, you must know how to source finance. You must understand the various sources of financing. What are the different methods company can adopt to raise finance? Now, when you have raised finance, your second function is how to utilize finance, the finance generated, how to use this finance to achieve company's objective. Now, having said that, Let us delve into today's topic proper. Capital structure and theories of gearing. The first point is, or the first question is, what is capital really? What is capital? You can define capital as money used to create, build, and run a business. Capital can be defined as the money used to create business, money used to build business, money used to run business. That definition captures capital. The money you use to create a business is called capital. The money you use to build your business, we have 3 stages. The first stage is you need to create a business. You need to establish a business. You require money to establish a business. When you establish the business, you need to build the business, expansion. You also require money to build your business. Lastly, we require money to run the business on a daily basis. We have defined capital. Number 2 item, types of capital. Basically, there are 2 types of capital. We have the equity capital and debt capital. Basically, there are 2 types of capital. One is the equity capital. Number 2 is the debt capital. What is equity capital? Equity capital is the money contributed to the business by the owners of the business. Equity capital. This is the capital contributed to a business by the owners of the business. Now the next question is, who are the owners of the business? The owners of the business are the shareholders. In other words, equity capital represents shareholders' contribution to the business. Next, debt capital. Debt capital refers to all forms of borrowings. All categories of borrowings are regarded as debt capital. What's this comment here? Anayo, please help me. Of course, we are assuming that there is zero knowledge here. That's why we are taking step by step. Debt capital. Debt capital refers to all forms of borrowing. Anytime a company borrows money, borrowing will be categorized as debt capital. You can have short-term borrowing, medium-term borrowing, and long-term borrowing. Also note, preference share capital is classified as part of debt capital. Preference shares capital is classified as part of debt capital. You can also define debt capital as all money to the business that is not coming from shareholders. Please.
Yeah. You can go. It's from here.
It is coming from a fine. You know, you might not even be aware that it's disturbing the class. If I Amechi, you are conflicting our class.
How much is that method? That method. The blue buy.
We have to wait for him.
Yeah, wait.
Yeah.
Hey there. Completing my class, please move that, please. We have treated capital reconstruction and
Thanks.
BB. Please, can you mute?
Elijah, please, can you just please mute your speaker? We have Elijah, I have Ifeanyi, I have Grace, I have Abubakar. All these things may disturb this class. The rule of the engagement is, Ifeanyi, please, I might be forced to take somebody out of the class. Because this Ifeanyi is conflicting my class. Apparently, it's not even aware that it's disturbing the class. Let's go. All right. You can define debt capital as all money to the business that is not coming from the shareholders. So your debt capital includes all forms of borrowing, including preference shares. Please note that preference share capital is part of debt capital. We have explained what is capital. We have explained types of capital. Our next discussion, what is capital structure? Capital structure can be defined as the different types of capital a company has used to run its activities. Capital structure, you can define it as the different combinations of capital that a company utilizes in carrying out its activities. Usually, the capital structure will include, the capital structure of a company will include the ordinary share capital, equity reserves, and long-term borrowing in the form of debentures. Usually, the capital structure of a firm will include ordinary share capital, equity reserves, and long-term borrowing in the form of debentures. At times, business entity may rely on short-term borrowing, such as bank overdraft and short-term trade credits, for considerable part of the capital structure. So the capital structure of a firm shows the different types of capital the company has used. You can have ordinary share capital. You can have equity reserves. You can have long-term borrowings. You can have short-term borrowings as part of your capital structure. A company may be financed by equity only. A company may be financed by equity only. Where a company is financed by equity capital only, such company will be regarded as ungeared. Please note that. Ungeared. Mr. Jami, please, can you mute? Olusoji, please, can you mute? I will repeat that. Where a company is financed by equity only, such company will be regarded as ungeared company. If you pick a company financial statement, the statement of financial position, go and look at the capital side. You know, if you pick a balance sheet, you have non-current assets, current assets, you have current liabilities, non-current liabilities. You now have financed by. Go and look at how the company is financed. If you observe that that company is financed by equity only, equity capital only, then such company is classified as ungeared. Where a company is financed, alternatively, where a company is financed by a combination of equity capital and debt capital. Such company is regarded as geared company. Please log that in. A company may be geared or ungeared. When we say geared, it means that that company has debt capital. Mr. Moses.
Yes, sir. Good evening, Ashoji, sir.
Yes, sir.
I'm just coming in. I went out to do something. Please, can you explain the care and the uncare very well, please? I came in between when you were explaining care, but I don't know how you explain the uncare.
And we are
Thank
still
you,
on
sir.
it now.
All right. I thought you were about to move on from it.
No, we are still on it. I said, where a company is financed by equity capital only. What is equity capital? Money contributed to the business by the owners of the business. Where you finance your business with only your own money, that is equity capital. Such company is classified as ungeared company. Alternatively, when you finance your business by a combination of equity capital and debt capital, such company is regarded as geared company. Is that clear, please?
Yes, sir.
If you find yourself in the examiner says, this company is ungeared. What the examiner is telling you is that this company does not have debt capital. If you find in the examiner says this company is geared, that means the company have both equity capital and debt capital. All right, let's move on.
Yes, sir. Yes, sir. Yes, sir.
Assuming I can mute, I will have mute everybody now. We have to discuss with the management, because at times some might not even be aware that the speaker is up. But the problem is, if you take the route to mute everybody, that means you can't ask questions except you chat. So the onus is on the student to constantly check your speaker. All right, our next discussion, risk. What is risk? Risk is the variability in business return. You can define risk as what? The variability in your business returns. You can also define risk as volatility in business return. You can also define risk as fluctuations in your business return. I've mentioned three things. You can define risk as variability in returns. Or you can define risk as volatility in returns. Or you can define risk as fluctuations in your business return. The higher the variability, the higher the risk. The higher the fluctuation in your return, the higher your risk. Risk can be classified into two. One is the business risk. Two is the financial risk. Risk can be classified into two. One, we have the business risk. What is business risk? This is the variability of the firm's operating income. Variability of the firm's operating profits. The fluctuation in a company's profit, operating profit, is the business risk. Business risk is associated with the nature of the business a company is involved in. Please note this down. Business risk has to do with the nature of your business. For example, banking business. What is the risk associated with banking? Whether First Bank, whether Zenith Bank, whether GT Bank. Fraud is peculiar to bank. Fraud is highly peculiar to bank. Simia, please mute. Ibrahim. There is the tendency that there could be internal fraud or external fraud. Look at manufacturing business. For example, bakery business. Look at bakery business. What is peculiar to bakery business? What is the risk peculiar to bakery? Bread is perishable in nature. If you bake bread today, the next day, 2 days later, that customer might not buy. Most customers will prefer the bread for today, the fresh bread today. So if you find yourself in a bakery business, you must be aware that there is the high tendency that if you don't make sales, if you cannot finish your sales in a day, you might incur losses for on those bread that you cannot sell a day later, 2 days later. The risk is peculiar to that business. So business risk has to do with the nature of your business. Next, financial risk. What is financial risk? This is the additional variability in returns to shareholders. This is the additional variability in returns to shareholders that arises because the capital structure contains element of debt finance. I'll take that again. Financial risk. This is the additional variability in returns to shareholders. Financial risk arises because there is debt capital in the company's capital structure. Financial risk is purely associated with debt finance. Financial risk, please note that, is purely associated with debt financing. The only time a company will have financial risk is because the company has borrowed money. Where a company has not obtained borrowing, there is no financial risk. Please note, where a company is financed by equity only, where a company is financed by equity capital only, then the financial risk of the company will be zero. Any question, please? We have explained what is capital. We have explained the types of capital. We have explained capital structure. We have explained geared and ungeared company. We have explained risk and types of risk. Any question, please? Okay.
Yes, sir.
Yes, Anayo.
Thank you, sir. Sir, please, in a case where a subsidiary company is getting injection from the parent company, can we classify or can we say that that company is not at a financial risk?
What do you mean by getting injection?
When a parent company, the directors of a parent company is as the same the directors of a subsidiary, and they are, those directors from the parent company are the one financing, apart from the ordinary shareholder listed in the share structure.
This one is confusing, huh?
Okay.
For instance, let me clarify. For instance, the shares were listed as 100, but in another day, like 2 years, the parent company of this subsidiary has injected like 200 million, which is part of equity to that subsidiary.
Okay. For simplicity.
Yes.
Are you there, please?
Yes.
The parent company is the principal company.
Yes.
And it can determine whatever it like with the subsidiary. Are you there, please?
Yes, sir.
The parent company is the principal company. It can determine whatever it likes with its subsidiary. Subsidiary is taking its life from the parents. So the issue of capital structure, what should concern us as finance manager is how is the subsidiary being financed? Does it have equity capital or it has equity and debt capital? The structure of the equity capital is not our business here. Please, I'm coming.
Okay,
What
sir.
should concern what should concern us as finance manager with respect to this discussion is that you look at the capital structure of the subsidiary. Is it financed by equity or a combination of equity and debt? The composition of the equity capital is not our business. I hope it's better.
Okay. Yes, sir.
So that we don't create confusion where there is none. Yes, Mr. Lanriwaju.
Thank you, sir. Please, in addendum to my colleague's question, now if the parent company is the main shareholder of the subsidiary, for example, First Bank is a equity holder in, let's say, FBN Microfinance Bank. That is, they are the equity shareholders. Okay. And another instance is that the director, without recourse to their shares in First Bank, are directly the equity shareholders of FBN Microfinance Bank. What are still considered as equity, either way?
Yes, of course. That's the thing I'm saying. You know, okay. First Bank directors has invested, has created another company now. They now invested their money in another company. That means the First Bank director are the equity shareholders in First Bank Microfinance. In the capital structure of First Bank Microfinance, they are going to have equity capital. Polite, please can you mute? It appears the speaker is off. Polite. Oh. All right. So what you are going to look at is, you know, when you pick the financial statement of First Bank Microfinance, what you are going to see is equity share capital. We don't know the owners of the shares. We are not interested in the owners of those shares. The bottom line is that FBN Microfinance is financed by what? Equity. Who owns the equity is not our business here. The next thing is that is First Bank Microfinance financed by debt. You know, when you look at the capital structure, you only see share capital. You don't know who are the owners of the shares. As far as this topic is concerned, we are not interested in who owns the shares. Our interest is that this company is financed by equity shares. That's all. You now go and check, is this company financed by debt? Has this company borrowed money before? If the answer is yes, that means the company is financed by equity capital as well as debt capital. That makes the company a gears company. I hope this point is clear.
Yes, sir. Sir, but there is a question my colleague threw now. In a situation, is there a situation whereby a company can be financed by only debt, excluding equity? And can that be said is gearing?
That's a good question. Can you mute, Anayo? According to the law, the owners of the business can finance their business the way they like. There is no law regulating how you finance your business. If you like, finance your business with equity. If you like, finance your business with equity and debt capital. if you like, finance your business with debt only. So there is no law regulating how a company should be financed. However, if you finance your business with debt capital only, that means you have borrowed all the money. If you borrow all the money, who is the owner of the business? That means you are not the owner. The lenders are the owners of the business. If you finance your business with debt only, that means you have borrowed all the money. And the question is, who is the owner of the business? The lenders are the owners. Whoever contributes money to the business, they are the owners of the business. So technically, you are not the owner. And nobody will set up a company to borrow all the money 100%. No human being will set up a business and say, let me go and borrow all the money. One day, the lender will wake up and collect the company from you. Because they are the one that gave you the money. They will just withdraw their money from the business. That's all. So, technically, you can never see a company financed by debt only. All right, we need to move.
Just a quick one, Mr. Suaju. When we are talking of a debt capital, are we referring to long-term alone or both short and long-term, sir?
Okay, I mentioned it. You can use short-term debt capital. You can use medium-term debt capital, and you can use long-term debt capital. Your capital structure means the different types of capital you have used. It could be long-term capital. In most cases, company will use varieties of capital. In most cases, company will use equity capital. Company will use debt capital. That your debt capital, the company will have short-term debt capital, medium-term debt capital, and long-term debt capital. So your capital structure shows the different types of capital you have used. All right. Our next discussion, measurement of risk. How do we measure this risk? We have explained business risk. We have explained financial risk. So our next discussion is the measurement of risk. We are going to start with financial risk. How do we measure financial risk? I'll take it down a bit. Yeah, measurement of financial risk. The financial risk of a company. The financial risk of a company's capital structure. Let me take that again. The financial risk of a company's capital structure can be measured by gearing ratio, debt ratio, or interest cover ratio. You can measure financial risk Financial gearing. You can use to measure your financial risk. Or you can use interest cover ratio. In other words, the first one is, please can you use to measure financial risk? What? Sorry, I have a temporary network glitch. It's a temporary network glitch. So when you are not getting, I will come back. So please, can you help us mute? This distraction, I'm not enjoying it at all. Somebody's in his car and is conflicting the class. Elijah. Let's go on. We said financial gearing. What is financial gearing? This measures relationship between shareholders' funds and prior charge capital. Financial gearing measures the relationship between shareholders' fund, that is equity funds, and prior charge capital. Financial gearing indicates the degree to which the company's activities are funded by borrowed funds. Please note this down. Financial gearing indicates the degree or the extent to which the company's activities are funded by borrowed funds. Gearing is the extent to which a company has borrowed money. You can measure the financial risk by computing financial gearing. Now the next question is, how do we calculate financial gearing? Please note, financial gearing can be calculated using book value approach or market value approach. Please note, you can calculate financial gearing using book value approach or market value approach. You can now ask me, what is book value approach? Book value approach means the figures in your balance sheet the balance sheet figure. Remember, your balance sheet or your statement of financial position is prepared based on book value. So you are going to pick the figures in your balance sheet as given. That is the book value approach. If you are to calculate financial gearing, we have like 3 different formulas based on book value. Look at it, please. Financial gearing is calculated as prior charge capital divided by equity capital, including reserves. Capital, including reserves. You multiply by 100 to give you percentage. Where your prior charge capital is debt capital plus preference share capital. The debt capital we are referring to is long-term debt capital. Please, let's put a clause here. Long-term debt capital. The long-term debt capital plus preference share, that will give you the prior charge capital. Then you divide it by the equity capital, including reserves. You can compute gearing with that formula. Or you can use the second one. Prior charge capital all over equity capital plus prior charge capital. You can also calculate your gearing in this slide. The third one is for financial gearing. You can use prior charge capital divided by total capital employed. Your total capital employed will include both the long-term capital and short-term capital. Your total capital employed will include equity capital, long-term debt capital, preference share capital, and short-term debt capital. Any of these 3 methods can be used to calculate financial gearing based on book value approach. In most cases, the examiner will tell you which of the methods to use. In most cases, the examiner will specify which of these methods to use when calculating financial gain. However, in a situation where the examiner is silent about the method to use, then you are at liberty to use any of the methods. Where the examiner is silent about the methods to use, then the student is at liberty to use any method. Then specify the method you are using. This is how to calculate financial gain with a view to measuring your financial risk. Remember, we said You can measure financial risk using financial gearing, debt ratio, or interest coverage. Next, calculation of financial gearing using market value approach. Yes, total capital employed is made up of all the capital employed, including prior charge capital. The component of total capital employed are equity capital, long-term debt capital, short-term debt capital, preference shares. All the capital you can see in that question, you are going to pick it. All the capital you can see in the question, you are going to pick it. All right, my next discussion. My Marco, please can you mute? Sulaimon has been keeping this speaker. Calculation of using market value approach. What is market value? The price of the market price of the equity. Market value. Financial gearing becomes divided by the market value of equity capital. Or you can use market value of prior charge capital divided by the market value of equity capital plus the market value of prior charge capital. You multiply your answer by 100 so that you can get percentage. Next, measurement of financial gearing using debt ratio. Is it here? It should be here. Yeah, look at it. The measurement of financial gearing, you can also use interest cover ratio as well as debt ratio. What is interest cover ratio? How do we compute interest cover ratio? The interest cover ratio is the number of times the company's operating profit covers interest expense. The interest cover ratio. This is the number of times a company operating profit covers its interest expense. It is calculated as profit before interest and tax divided by the interest expense. Please don't multiply by 100. It is calculated in times, number of times profits can cover the interest expense. The higher the ratio, the better for the company. Then lastly, we have debt ratio. You can measure financial risk using debt ratio. Please don't forget, I've mentioned 3 things. If you are asked to measure the financial risk of a company, you can use financial gearing, you can use interest cover ratio, or you can use debt ratio. What is debt ratio? This is the ratio of total liability to total debt. Debt ratio. This is the ratio of total liabilities to total debt. This ratio shows the extent to which the company's assets can cover its liabilities. This ratio shows the extent to which a company's assets can cover its liability. Logically, assets should be more than liability. Otherwise, there's problem. Logically, the business assets should be more than the business liability. The company should have enough assets to cover its liability. All right. We have explained how to calculate, how to measure financial risk. My next discussion is measurement of business risk. Recall, we have 2 types of risk: financial risk and business risk. So let us look at the measurement of business risk. Recall, what is business risk? Business risk is the risk that a company may achieve low profits or even incur losses due to the nature of the company's business. Business risk. The risk that a company may achieve low profits or the company may even incur losses due to the nature of the business the company is involved in. You can measure the business risk by calculating operational gearing. You can measure the business risk by calculating company's operational gearing. What is operational gearing? This shows relationship between contribution and profit before interest and tax. Operating gearing measures the relationship between contribution and the profit before interest and tax. It indicates the degree to which a company's profits are made up of variable costs. Operational gearing shows the extent to which a company's profits contain variable costs as opposed to fixed costs. How do we compute operational gearing? We have like 3 ways of calculation. You can compute your operational gearing as contribution divided by profits before interest and tax. You can compute your operational gearing as contribution divided by profits before interest and tax. Multiply by 100. Ahmed, please mute. You can also compute your operational gearing as you can measure business risk by calculating operational gearing as total fixed costs, the ratio of total fixed costs by total cost. You can compute your operational gearing as that. Or you can use total fixed costs divided by total variable cost. You can calculate operational gearing with any of these formula. What is the significance of operational gearing? First point is, if your contribution is high, if the contribution is high, but the profit is low, this is an indication that the company has higher proportion of fixed costs. If the contribution is high, but the profit is low, it's an indication that the amount of fixed cost is large. In this case, the business risk as measured by operational gearing will be high. Once your fixed cost is high, compared to your total cost or variable cost, then the operational gearing is high. That means the business risk is very high. Let me ask the class, what is fixed cost? What is variable cost? Yes. What is fixed cost? What is variable cost? Why is it that when the fixed cost is high, that means the business risk is high? Any attempts? Any attempts?
It remains that whether they make profit or loss, the fixed cost is there. It's there for them to. It's an expense that is fixed in nature, regardless of the level of activities going on in the company.
Oh, okay, that's good. It's an expense that is fixed in nature, regardless of the activities. It's a good way of responding. What she's trying to say, in my opinion, is that their cost is fixed. Whether you produce or you don't produce, that cost is still there. For example, your business rent is fixed. If you like, don't produce. If you like, produce. You are still going to pay that cost. Let me see comments from the charts. Okay, yeah. Costs that do not change with the level of production or sales. If the company fixed cost is high, that can put the life of the business at risk. Because you must make enough profit to be able to cover that higher fixed cost. If you don't make enough, you must make enough contribution to be able to cover your fixed cost. If your contribution is small and your fixed cost is high, what will happen? Profit, you are going to incur loss. That's a good one. All right. A quick recap of our discussion, because I want to stop here and go to question. A quick recap of what we have discussed. We look at what is capital as the money we use to run a business, to create a business, to build a business. We look at the types of capital, equity capital, debt capital. We look at the capital structure. That is the different types of capital a company use to carry out its activities. You can have ordinary share capital, you can have debt capital, you can have preference share capital, and you can even have short-term capital. We now look at risk. Risk is the volatility in your return. Risk is fear, the fear that your return may be lower than expected. We now classify risk into two. We classify the risk into two areas. What is the business risk? Risk that has to do with the nature of your business. The risk that a company may achieve low profits, or a company may incur losses due to the nature of the business the company is involved in. Due to the nature of the company's business. Financial risk. How do we measure business risk? You can use operational gearing, which is the ratio of contribution to operating profits. Or you can use ratio of fixed cost to variable cost. Or you can use ratio of fixed cost to total cost to compute your operational gearing with a view to measuring your business risk. We look at the measurement of financial risk. You can use financial gearing or interest cover ratio or debt ratio. We shall stop the explanation here. Let us go and practicalize. Let us demonstrate question with the lecture we have gotten for almost 1.5 hours now. Let us demonstrate question. Let us demonstrate question with the knowledge we have acquired so far. You can refer to your study pack. It's available in your study pack. The study pack has been shared with the group. Go to capital structures section. Look at question number 1. It's advisable for all students to look at this question. We want to demonstrate the knowledge we have acquired with calculations. Please refer to the soft copy on the group chat. Check where you have capital structure. Look at question number 1. Can somebody confirm the page to us? Anybody have opened it? Mr. Johnson, I can hardly hear you. Okay, let me check.
151.
Okay, page 151. Thank you, sir. Question number 1. All right, I'll read. Earpiece plans to raise, let me expand this more. Just to expand small. Just small. Okay. Okay, can take it up now. All right. Who is chatting me here? It's page 150. All right, no problem. Thank you, Tim Tokwe. Earpiece plan to raise $5 million in order to expand its existing chain of transport businesses in Nigeria. It can raise the finance by issuing 10% loan stock redeemable in 10 years' time. Please underline. This company is trying to raise finance, £5 million. It can raise the money by issuing 10% loan stock redeemable in 10 years' time. Please note, loan stock is a debt finance loan. So the company wants to raise a debt finance of 10%, redeemable in 10 years' time, or by a rights issue of 4 naira per share each, of 4 naira per share. A rights issue is part of equity finance. So if you look at that paragraph, the company wants to raise £5 million. It can either use debt finance, which is loan stock, or equity finance, which is rights issue. The current financial statement of Earpiece as follows. You have the statement of profits or loss. Currently, you have the revenue, cost of sales, gross profit, admin cost. Every other thing is there, no problem. Next, change in equity, dividends. Then you have net change in equity, which is retained earnings. Out of this profit of 3,990, the company picked a dividend of 2,394. Retained earnings is 596. Next, statement of financial position. That is your balance sheet. Look at the statement. Net non-current asset is given. Net current asset is given. Next. Okay, I'm back. We have ordinary shares, par value, 25 cents. That is 25 kobo. $2,500. Retained profits, 20,060. Then we have 12% loan stock, redeemable 6 years time. Good. Look at this company capital structure. This company is financed by, please pay attention here now. Look at LPs. LPs is financed by ordinary share. This is equity. It's also financed by 12% loan stock, redeemable 6 years. This is debt. That means is financed by equity and debt. That makes LPs a geared company. The company is financed by ordinary share capital as well as loan stock. Loan stock is a debt capital. Is expected to, that means if the all right, that's due to network glitch. But we are back. Occasionally you can have network glitch, but try to relog on. That is one of the risks with online class. All right, let's continue. Variable cost of sales makes up 85% of cost of sales. Look at that statement. The cost of sales, 85% of the cost of sales represent variable cost of sales. That means if 85% cost of sales is variable, what is the balance?
15%.
Fixed.
That 15% is what?
Fixed.
Fixed.
Thank you. 15% represent fixed cost of sales. You know, as you are reading question, you are going to quickly be interpreting this. Variable cost of sales makes up 85% of the cost of sales. That means the balance is 15%. 100% minus 85% will give us 15%. That means 15% represent fixed cost of sales. Admin cost Administration costs will increase by 5% due to new staff appointments. APIS has a policy of paying 60% of its profit after tax as dividends and has no overdraft. This company does not have short-term debt finance, no overdraft. 60% of the company's profit is paid as dividends. Now, requirements 1. Requirements 1. Please get your writing pad, your book, your pen, and your calculator. For those that are familiar with our system and my class, part of what we solve in this class is likely to be in your exam. There is the possibility that some of the questions we are going to solve will be repeated in the exam also. Why do I say you should get your pen, your calculator, your writing pad? I'm aware that the video will be circulated tomorrow. But to remain active in class, because some might log on and be sleeping. After the day's work, you are now coming to online class, probably in your bedroom. Somebody can sleep off. But for you to remain active, make sure you are jotting down something. All right, let's go to it. Requirements A. For each financing proposal, prepare the forecast statement of profit or loss after one additional year of operation. That means forecast the income statement for 1 year. Then B says, evaluate and comment on the effect financer on the following: financial gearing, operational gearing, interest cover ratio, and earnings per share. Let us start with A. We want to forecast the income statements for the first year. If the company go into expansion, the expansion can be financed either by loan stock or rights issue. All right. If you are ready, I'm ready for calculation.
We are ready, sir.
We are ready, sir.
All right, we're good to go. You have the company's name, APIS Nigerian PSC. Requirement A, forecast statement of profit or loss. We have two scenarios. They just 1 minute. Scenario, I want to create that two scenario. It should be it. Okay. one should be debt finance. The second one is equity finance. Okay. So what we are saying is this first column here, if the expansion is financed by debt, that is loan stock. Why the second one here is if the expansion is financed by RAM, you are going to open these two statements simultaneously. Remember, you are dealing with time. So you are going to open the two statements. This first column. All right. So this aspect is for, okay. Now let's go to it. Examiner says, look at the last paragraph. The expansion of business is expected to increase sales revenue by 12% in the first year. Let's go and check the income statement. What is this sales revenue currently? Look at it, please. Revenue currently is 50,000. Examiner say in year one, revenue will increase by 12%. Please increase 50,000 by 12%. What is the value now?
$56, sir.
That will give us, look at it.
1.12
come here. 50,000. You are making a mistake, Johnson. Rescheduling your class. Will not change the date of your exam. You are not even sure what will happen when you reschedule again. So don't agree to reschedule any lecture. Just try to maximize whatever you can take. I'm being factual with you. You know, we said there's risk. For whatever option you choose, there's element of risk involved. All right, let's continue. Now, please confirm that you understand how we come about 1.12. Revenue will increase by 12%. Now, what you need to do is that 12% plus 100%, that will give you 112%. Divided by 100, that will give you 1.12. Please multiply. What is the revenue for forecast? What do you have here?
56,000.
56,000. Whether you finance the expansion by debt or you finance the expansion by equity, revenue in year one will be 56,000. Whether you finance the expansion by loan stock is debt finance, or you finance the expansion by equity, right issue. Right issue is equity finance. Your revenue in year one will increase by 12%. We have treated that. Next. Variable cost of sales made up 85% of the cost of sales. Let's go to this. What is the cost of sales? Please look at it. Currently, the cost of sales is 30,000. Can we see it?
Yes, sir.
Now, 85% of 30,000.
That is 55,500.
So you come here, let's go and do the working. I'll do it here. Let me do it down here. Working one. Variable cost of sales is equal to 85% of $30,000. What do you have? What do you have, please? Let's make it faster.
55,500.
25,500.
25,500.
Thank you. Now, the increase in sales will affect variable cost of sales. Your increase in sales will only affect variable cost of sales. That means first year, the variable cost of sales will be 25,500. This will increase by 12%, 1.12. That will be the variable cost of sales forecast in year one. The increase in sales revenue will only affect the variable cost of sales. What do you have here?
28,550.
28,550. Our fixed cost of sales. Fixed cost of sales.
It is 560, not 550.
28 what?
560.
560.
560. Okay, thank you, sir.
Okay. This might want to be serious.
So please don't forget, the increase in sales will only affect variable cost of sales. Fixed cost of sales is equal to 15% of cost of sales. 15% of 30,000. How much, please?
That's 4,500.
4,500. Your fixed cost of sales will not be affected by increase in sales revenue. That cost is fees. You can now return up. This will give me 28,560. Come here. I'll just put C working one. This will give me 28. 560. Whether we finance by equity, by debt, or we finance by equity, the variable cost of sales in the first year will be 28,560. The fixed cost of sales, 4,500. This amount is fees, 4,500. You can now get your gross profit. Sales revenue, less variable cost of sales, less fixed cost of sales. This will give you your gross profits. Please compute.
22,940.
What do you have?
22,940.
22,940. 22,940. Next, admin. Let's go back to the question. Examiner says, this is what we call, you are forecasting financial statement. Administrative costs will increase by 5%. Let's go and check. What is the admin cost currently? The admin cost currently is 14,000. This will increase by 5%. Please increase 14,000 by 5%.
That's 14,700.
That means you come here, 14,000 multiplied by 1.05. That will give me 14,700. 14,700. What you are doing is what we call forecasting statement of profit or loss. Now, get your profits before interest and tax. 22,490 minus 14,700. What do we have?
8,240.
8,240. 8,240. 8,240. Interest expense. Let's go to it. Now, if the expansion is financed by debt, that means we are going to borrow money. Is that not? Hello, guys.
Yes, sir.
If the expansion is financed by debt, that means we are going to pay more interest. Is that not?
Yes, sir.
Good. Let's go back to the question. Currently, our interest is 300.
Yeah.
Currently, the interest expense is 300.
Yeah.
Now we come here. Look at it. We can raise the finance by issuing 10% loan stock. That means the interest on the new debt is 10%. We are going to borrow 5 million new debt. We are going to pay 10% on new debt. What is the interest amount? Let's go to working two.
$500,000.
Thank you. That will take us to working two. Working two. If the expansion is financed by 10% loan stock, new interest is equal to, we have existing interest is 300 plus the new interest, 10% of 5 million. That means our new interest is The existing interest 300 plus the new interest 500. Our new interest is 800. That is, if we finance the expansion by loan stock, the interest will be, come here, this will be 800. But if we finance the expansion by equity, would the interest increase? Hello, guys.
No.
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 Thank you.
No.
The
No.
interest will remain what?
300.
300. Thank you. You have to be smart with the question. Get your profit before tax.
7440 for debt.
7440 for debt. For equity.
7940.
79440. The tax rate is 30%. Let's look at it in the question. Is there any question?
Yes.
Yeah, 30% is the tax rate. Yeah, compute. Compute 30% of 7,440. That's your tax.
2232.
It's bold.
2232. Compute 30% of 4,940.
2382.
2382. Now get your profit after tax.
$5,208 for the debt.
Debt.
5,208.
208. Oh yeah, get your profit after tax for
5558.
5558.
5558.
5558. The question says the company pays 60% of its profits as dividend. Is there any question? Look at it. APIS has a policy of paying 60% of its profit after tax as dividend. Let's go to it. Dividend, 60% of profit after tax. Please compute.
3125. 3125 approximately.
3124.8.
Okay, approximately
3125.
25.
3345.
Excuse me, sir.
3335.
3 what?
3335.
Yes, Folashade route.
Yes, sir. I don't know why we are using 60%, but we have 50% in the question.
Okay, please adjust. It's an error. It's 60%.
Okay.
Okay, all right, sir.
And look at it. I saw it later. I have to adjust it. Roots. You're always helping students that just joined the class. Then the difference between your profit after tax less your dividend will give you your retained what? Retained earnings.
The first one is 2083.
2083. Retained earnings under debt finance.
The second one is 2223.
2222.
Yes, 2223.
You are done with the A part. You have done your forecast income statement for year 1. You are done with the A part of this question. The forecast statement of profit or loss for each financing proposal. Look at it. For each financing proposal, prepare the forecast statements of profit or loss after 1 additional year of operation. You have answered the A part. We have 30 minutes. Let's move to the B part. Evaluate and comment on the effect of each financing proposal on the following. Number 1, financial gearing. Let's go to that. How do we calculate financial gearing, please? You can use, look at it.
Charge capital over equity capital, including
Correct.
reserve.
Thank you. Closing reserves. Your prior charge capital, that is your long-term capital plus preference shares. In this question, there is no preference shares. So we are going to look at firstly, then proposal 1, finance by debt. So let's go to it. Let's go and check our current statement. What is the prior charge capital? Currently, our debt capital is 2,500. Based on the current financial statement, before the proposals, our debt capital is what? 2,000. Look at this.
2,500.
Then you pick that figure straight. I'll come here. Currently, the prior charge capital is 2,500. Okay, let's go to currently. What's our reserve? Share capital plus reserve. Let's go to it. Based on the current statement, the share capital is 2,500. Abi?
22,560.
You plus these two. Yeah. 2,500 plus 20,060. Let's go and show it. And it's good to show it. Know why? Some might be wondering, how did they get this figure now? So let's try to find a way to show it. Let me go down a bit, because yes, you may understand it, but I also know I have different categories of students. I'll come here. Current. That will give me, that is current. We have current, and that will give me 2,500 plus 20,060. That will give me how much, please? 22,560. So I can go up now. like this. $22,560. Now, if this expansion is financed by debt, that means our debt will increase. Is that not? Hello, guys. Hello.
We are together.
Now, if the expansion is financed by debt, that means the debt of the company will increase. Look at this.
Yes, sir.
Yes, sir.
Debt finance. Existing debt. Existing debt
It's
is
300.
2,500. Abi? New debt, we are going to borrow 5 million. Abi? That means total debt now is what?
7.5.
Thank you. Come here. If the expansion is financed by debt, that means our debt will now be
7,000.
7,500. Okay. But if the expansion is financed by equity, will the debt increase?
No.
The debt will remain 2,500.
Yes, sir.
Good. Let's go to share capital and reserve.
Hello, sir. Good evening, sir. Please, how did you get that? How is that new debt 5,000? How did you get that 5,000?
Okay, no problem. No problem. You can look at this. Airpeace plan to raise 5 million in order to expand its existing chain of transport business. So we want to raise 5 million. It can raise the finance by issuing 10% loan stock. That means you can raise the finance by issuing 10% loan stock. You can get your 5 million by issuing a loan stock. A loan stock is debt finance. Is that clear, sir? How is it 5,000 in that? You know, we have 30 up. I hope it's better.
That's million. Yeah.
Okay, thank you, sir. Okay. Now let's go to it. We are now on share capital and reserves under debt finance and equity finance. Okay. Look at it. Under debt finance and equity finance. Please look at it too. We have existing share capital. Is that not? The existing share capital is
Yes, sir.
2,500. Whether debt or equity, existing is this. Our existing, now, if you use debt finance, we now have new share capital, new shares. Assuming the business is financed by debt, are we going to issue new share here?
No.
No, sir.
Let me take it again. Assuming we finance the expansion by debt, are we going to issue new shares?
No.
No,
Yes.
sir.
Good. But if you finance by equity, are we going to issue new shares?
Yes.
Yes, sir.
We are going to issue new shares that will give us how much? 5 million. You don't require 5 million, is that not? The money we needed for the expansion is 5 million. That means if you finance it by right issue, you must issue new shares that will give you 5 million. Is that point clear, please? Hello.
Sir, please, is the I thought on the question.
Okay, who is speaking? Oluchi. Yes.
Oluchi. So I thought they stated in the question that the preference shares will be increased by 10%, right? 10% loan. No, 10% loan notes. They will raise the debt by 10% loan notes.
Loan stock.
Okay. This equity now, this equity now, how come we are using 5 million for the equity, but they stated 10% loan stock?
Okay. Oh, yeah, let all of us listen. APs plan to raise 5 million naira. A company called APs plan to raise $5 million in order to expand its existing chain of businesses. That means, imagine that you are the accountant here. Your company wants to raise 5 million. The money you needed is 5 million naira. 10% loan stock. Loan stock is, what is the finance? The finance is 5 million. Are you there, please? The finance is what? 5 million. You can raise this finance by issuing 10% loan stock. Or
which is debt.
Or by a rights issue. Can you see it now?
Okay.
So you have a choice to use either debt finance to get your 5 million, or to use rights issue, equity finance to get your 5 million. If you use debt finance, that means your equity will not increase. Is that not?
Yes.
If you use equity, that means your debt will not increase.
Yes.
Is it getting better, please?
Yes, sir. But sir, please, I still have one question. But they say that by right issue of $4 per share.
One share is $4. That means you must issue the number of shares that will give you 5 million naira. What you needed is 5 million naira. So we are going to issue number of shares that will make us to generate 5 million naira. What concerns you in your capital, in your share capital is, what is the total amount we are going to generate if we issue the shares? We are going to generate 5 million. That means our equity will increase by 5 million. Is it better, please?
Okay, thank you, sir.
Mansuru.
So we don't have anything to do with the number of shares by dividing by the $4.
If you divide again, you are just
you get the number of shares.
You are still going to get, what you needed is the value, the total value of the shares. To compute gearing, you don't need number of shares. Hello? To compute your financial gearing, you do not require number of shares. It is the total naira value of the shares. Yes, Mr. Shekoni.
Yes, sir. It's quite understood, sir. I think the underlying factor is the can, that it can, that is, or, so either use debt or equity. That's the second paragraph. So the statement follows the full stop after Nigeria. So it is the company is saying that they needed to raise 5 million by equity, or that then it can raise the finance by, meaning, or by debt. So that's just the, yes. So it raised two options.
Yeah, there are two alternatives here.
Yes.
You can either use your debt or your equity. So look at it again. Don't worry, we are going to be anywhere we get to, we stop. We expected that this is the first time you are doing this at lower level, at skills level. Look at it. Look at it now. I said under debt finance, we have the existing shares, which affect both debt finance and equity finance. The new share, assuming we finance the expansion by rights issue, this will not affect debt finance, but it will affect equity. You now bring in your reserve, existing retained earnings, retained earnings. Whether debt finance or equity finance, the retained earnings is 20,000 existing, 20,060. 20,000. We know we are trying to get shareholders' funds. What we are trying to get is shareholders' funds. Share capital plus reserve. This is existing retained earnings. Now let's go and look at new retained earnings. Please go back to your forecast. Come here.
3223.
2083 under debt, Abby?
Yes.
Under equity.
223. Yeah, I have 2083.
And 2223.
2223. You can now get
Sir, you wrote
share
82 instead
capital.
of 83.
I didn't get that, please.
2083, not 82.
So you can now have what we call share. This is what we call shareholders funds now. Share capital plus reserves. Add 2,500 plus 20. Add these three. Add here. What do you have here?
24,643.
24,643. What do you have here?
27,783.
27,783. This is what we call it
29,783.
Oh, 29, Abby. 9, right?
Yes, sir.
29,783.
So this is what we call calculation of shareholders funds. Shareholders funds is the addition of equity capital and reserves. Your reserve is your retained earnings. When we say shareholders' funds, all the money that belongs to shareholder is called the addition of share capital plus equity reserves. You can now pick 24,643, 29,783. You can pick this now. Apparently, this question 24,643, 29,783. You can now compute your gearing. The first one, 2,500 divided by 22,560 multiplied by 100. Please, let's compute fast.
11.08.
Come again, sir.
Multiply
You
by
said
100.
current
500 divided by what?
11%.
11.08.
08.
Yes.
Yes.
Hello, sir. I didn't hear you. You said 2,000. How did you calculate financial gearing?
We stated the formula before now. Please. Prior charge capital divided by equity funds. Look at prior charge capital, 2,500. Look at shareholders' equity funds, 22,560. So divide 2,500 divided by 22,560. What do you have? Multiply by 100.
$11.08.
11.08.
Approximately 11.1%. Move to this debt finance. Prior charge capital, 7,500 divided by 24,643. Multiply by 100.
30.4.
0.43%.
30.43.
43%.
30.4%. I don't need 3. Now look at this. 2,500 divided by 29,783. Multiply by 100.
8.4.
8.4%.
8.4%. You have computed gearing based on prior charge capital divided by equity funds. Alternatively, you can compute as prior charge capital divided by total long-term capital. What it means is that I'll just come here, I'll pick this, 2005, 7,500, 2005. Now, your total long-term capital, addition of prior charge capital plus shareholders fund, 2005 plus 22,560. That is total long-term capital. Add 2,500 plus 22,560. And put it here.
And 60.
25
25.060.
25
060.
060. Total long-term capital is equal to prior charge capital plus equity funds, in case you are looking at it. Come here. 7,500 plus 24,643.
32,143.
32,143. Please come here. 2,500 plus 29,783.
32,283.
32,283. You can compute financial gearing now. Prior charge capital divided by total long-term capital. 2,500 divided by 25,065.
9.97.
What do you have?
9.97.
9.97.
Can't be enough. What are you calling?
Yes, Naomi.
2500 divided by 25065.
2,500 plus 22,560. Is it 2565 naira or 2560 naira?
Are you asking me?
I think that
Tell us your
calculation
own
is
answer.
There's a mistake here. That thing is 25,060 naira, not 65 naira.
25,000.
Is 60, not 65.
Now. So just tell us your own answer. Me, I don't have calculator here. People that will do the calculation and give me. So, but it shouldn't affect the answer much.
It's
You
still
can
the same
recompute this.
thing, 9.97.
Exactly. Now, please compute this for us. 7,500 divided by 32,143. Multiply by 100.
23.3%.
23%.
23.3%. The last one.
7.74.
7.7%. Okay. We have computed the financial gain. We have used two methods. If you now want to comment, look at it. Currently, the company financial gearing is 11% approximately. By bringing in more debt, the financial gearing has increased to 30%. That means the financial risk of this company has increased to 30%. By borrowing more money through
equity,
loan stock. You don't borrow money by equity now. You borrow money through loan stock.
No,
The
okay. I thought you were done with that. I thought you were done with that. Go on, sir.
The financial risk of the company has increased. But if we finance the expansion by right issue, equity, what has happened to the risk?
It reduced.
It has reduced.
Thank you. By financing the expansion through right issue, the financial risk of the business will reduce. The same comment apply here. Before now, the financial risk was 9.97%. By borrowing more money for the expansion, the financial risk increased to 23%. But if you finance the expansion by right issue, equity, the financial risk will reduce to 7%. What it means is that equity financing will always reduce your financial risk. Debt financing will increase the financial risk of the business. Wow. Obviously, we have to stop here because our engagement is to stop by 11 p.m. Even if I want to, if I have my time to continue, we have an engagement with the students because we are still going to office. We are going to our offices, individual office tomorrow. We still have other aspects. We have operational gearing, what have you. So we have to stop here. Any questions so far?
Hello, sir. I have a question, sir. Can you hear me?
Of course, I can hear you, David.
Yes, sir. Okay, please. Can you go to your solution where you have full debt and equity financing?
That is the working, right?
Yes, sir. So my concern is with the equity finance. You said if we're going to use debt financing, apart from the fact that the current debt is 2,500, we're going to have an additional $5,000 debt added to 2005. But when we did the equity finance, you still have the same current equity you have as at when assuming we use equity. Meanwhile, we're supposed to raise additional 5,000 equity. Why didn't you add it up? Like I'm just asking.
You know, I don't understand what you're saying.
Like if we're using equity finance, we're going to raise additional 5,000 equity. We're going to sell 5,000 shares through the right issue. Now we're going to issue 5,000. Yes. So why didn't you add it to the equity finance? Just the way we added the 5,000 debt as the loan stock to the 2,000.
But we added it now.
Equity finance is still 2,500 now.
No, look at it.
That one is the existing one. Why the new one? We have new one under it.
Please hold on. Oluchi, please hold on. Please look at this. Your prior charge capital is 2.5. This 2,500 under equity financing is looking at prior charge capital. We are saying that if you finance the business with equity finance, your debt will not increase. This 2,500 is prior charge capital, which is debt. Your debt will remain 2,500, but your equity will increase. Look at this, please. Share capital and reserve. If you look at this calculation here, 29,783. When we calculated, go and look at working 2. Look at this working.
Yeah, hello.
Oh.
Okay, want to go, Mumbo?
Oh, who is this?
Okay,
look
I
at
get
this,
this now, sir. Thank you.
Look at equity finance. Existing shares, 2,005. New shares, how much? David?
5,000. Yeah, I get it now. Thank you.
We have built it into it. All right. Please, it's understandable. If you are having some bit of confusion, take it calm. Go through it before next week. We are still going to solve more of gearing, calculation of gearing. It's an aspect of financial management. Throughout all the topics, you are going to be coming across calculation of financial gearing, because financial management is about how to manage risk. It's about how to source finance to generate more money. In sourcing finance, there is risk. The risk could be business or financial. So at every topic, we are likely to have gearing coming up. So please, as much as possible, let us look at it before the next lecture. I thought I'll be able to finish this question, but now I will be forced to come back to it at our next lecture, which I don't really like, coming back to question. We can't do that now. It's after 11. The cost outline has been shared with the group. Esther, are you there? So I don't have that luxury of time now to start running through course outline. All right, let's have a blessed evening. Good night. May God give us a better understanding.
Amen. Thank you, sir.
Please help us share the lecture notes, sir. Thank you.